All right, big week ahead. The Bank of Canada is about to make another interest rate announcement, and this one matters a lot because whether you're a homeowner with a mortgage, someone savings for a down payment, a small business owner, or just trying to keep up with the rising cost of groceries, what the bank decides this week will touch every part of your financial life. So let's break it down. Right now, the Bank of Canada's key policy rate sits at 2.75%. That's the overnight lending rate, the rate that influences everything else. The prime rate, variable rate mortgages, lines of credit, and even the rate you see on your credit card. Now, over the past year, the Bank of Canada has been holding things steady. Inflation has come down from scary levels that we saw in 2022 and 2023, but it hasn't fully gone away. The economy, on the other hand, is starting to show some real cracks. Last quarter, GDP actually contracted, down about 1.6%. That's not a blip, that's a real slowdown. And just last month, we saw the Canadian economy shed 65,000 jobs. That pushed unemployment levels that we haven't seen since 2016. So here's the tension. On one side, we've got a weakening economy, job losses, and consumers stretched thin. On the other side, you still got sticky inflation. Core inflation, which strips out food and energy, is still above the bank's comfort level. And if tariffs and trade disruptions push import costs higher, that inflation problem could flare back up again. That's the tug of war that the Bank of Canada is facing this week. Cut rates to support the economy or hold steady to keep inflation from roaring back. Most economists right now are betting on a quarter point cut. That would bring the rate from 2.75% to 2.5%. Markets are pricing that in as the most likely outcome, but it's not a sure thing. If inflation numbers come in hotter than expected, or that the bank wants to signal that they still want to be cautious, they could hold the rate. And that's what makes this week's decision so important. It's not just about whether they move 25 basis points or not. It's about the message that they will send. Are they more worried about growth and jobs, or are they still laser focused on the inflation risk? Because here's the thing. The bank's words can sometimes move markets just as much as their actions. The tone that they set in the press conference, the way that they talk about risk, the guidance they give for the months ahead, all of that matters. In this video, we're going to dig into the confrontation at the heart of the decision. The weak economy on one side, the inflation threats on the other, and the external risks, trade, the US economy, global demand. That makes this a razor-thin balancing act. This is the setup. Now let's dive into the conflict. So now that we've set the stage, let's get into the heart of the conflict, because the Bank of Canada isn't making this decision in a vacuum. They're balancing competing forces, the slowing economy on one side, inflation pressures on the other, and a whole bunch of external risks that makes this job even harder. Let's start with the economy itself. Over the past few months, we've seen clear evidence that the Canadian economy is slowing down. GDP shrunk by 1.6% in the last quarter. That's not a slowdown, that's a contraction, because businesses are pulling back, consumers are spending less, and you can feel that weakness on main streets across the country. The labor market, which is incredibly strong coming out of the pandemic, is now starting to crack. Just last month alone, Canada lost more than 65,000 jobs. Unemployment is now climbing, sitting at its highest level in almost a decade. That's not the kind of data that the Bank of Canada can ignore. And beyond the numbers, you can see the human impact. Families are feeling squeezed, mortgage payments are eating up the bigger share of the household income, groceries, gas, utilities are still very expensive. People are cutting back on discretionary spending, fewer dinners out, fewer big ticket purchases. Businesses are feeling it too, because when consumers stop spending, revenue dries up and layoffs become more likely. Now that's one side of the coin. The Bank of Canada could respond to this by cutting rate. Lowering borrowing costs would take some pressure off of households and businesses. Variable rate mortgage holders would feel a little bit more relief. Businesses looking to borrow for expansion or to just cover operating costs would have a little bit more breathing room. But, and here's a big but, inflation is still hanging around. Yes, headline inflation has cooled off from the 8% peaks of 2022, but it hasn't fully come down to the bank's 2% target. Core inflation, which strips out the most volatile components, remains sticky. That means the underlying price pressure in the economy haven't gone away. And that is where things get tricky. If the Bank of Canada cuts rates too aggressively, they risk sending a message that they are no longer serious about fighting inflation. That could weaken confidence in their commitment to price stability and expectations matter. If Canadians start believing inflation is going to stay high, that belief can become self-fulfilling prophecy. Workers demand higher wages, businesses preemptively raise prices, and suddenly inflation gets entrenched again. The bank knows this, and that's why they're walking such a fine line. Now let's layer on the external risks. First, look at the United States. The Federal Reserve has also been in easing mode, but for slightly different reasons. If the Fed cuts rates faster than Canada, that could weaken the Canadian dollar. A weaker loonie makes imports more expensive. Think of electronics, cars, food, which feeds right back into inflation. So if the Bank of Canada can't just ignore what the Fed is doing, then there's trade. Ongoing disputes and new tariffs have made the global trading environment unpredictable. Canadian exporters are worried. If demand for our goods and services weaken abroad, that means less economic growth here at home. But tariffs and trade disruptions can also push up the cost of imports, creating inflationary pressures. It's a lose-lose situation. Slow growth combined with high prices. And then there's the broader global slowdown. Europe is stagnating. China's growth is weaker than expected. Commodity demand is fluctuating. Canada, as a small, open economy, can't escape those forces. If the world slows down, we feel it. Whether that's the lower commodity prices, weaker demand for exports, or reduced investment. So here's the tug of war. The domestic economy is flashing red on growth and jobs, while inflation risks are still flashing yellow. That brings us to a scenario for this week's announcement. Scenario A, the base case, a 25 basis point cut. This is what most economists predict. The bank trims the policy rate from 2.75% down to 2.5%. It's a cautious move. It shows that they recognize the weakness in the economy, but they're not panicking. They're not slashing rates dramatically. They're just easing the brakes a little bit. Scenario B, a hold at 2.75%. Less likely, but it is possible. If the bank has concerns that inflation could flare back up, maybe because of tariffs, maybe because of energy prices, they could decide to hold. The message would be, we know that the economy is weak, but we're not ready to risk inflation heating up again. Scenario 3, a bigger cut, 25 basis points or more. This is very unlikely right now, but it's worth mentioning. The only way we'd see this is if the Bank of Canada believes we're heading straight into a recessionary territories. If the next steps of data were catastrophic, think of major job losses, a steep GDP contraction, then they might go more aggressively. But we're not there yet. Scenario D, cut now, signal more later. Another possibility is for the Bank of Canada to cut by 25 basis points, but use this statement in a press conference to signal that more rates are coming. This could be the most dovish option. It would try to boost confidence and tell Canadians help is on the way, but we're still watching data closely. Each of these scenarios has its risks. Cut too much, you risk reigniting inflation. Cut too little, and the economy suffers more than it needs to. Hold steady, and you could lose credibility with markets that are already pricing in the cut. That confrontation is not about where the policy rate goes this week. It's about how the Bank of Canada frames its decision. The word they choose, the risks they highlight, the guidance that they give about the path ahead. Those things will be just as important as the actual numbers they announce. So as we head into this week's meeting, the bank is caught between two fires, a slowing economy that's begging for relief and inflationary risk that could roar back up if they loosen too fast. That's the knife's edge they're standing on. And let's talk about what is the most likely outcome. What does it mean for you? And what should you be watching for when the announcement actually drops? So where does this all land? After weighing the risks, the most likely outcome this week is a 1/4 point cut. moving the policy rate from 2.75% down to 2.5%. That's not a guarantee, of course, but given the weakness in the economy, the job losses, the contraction in GDP, the strain on households, the bank will want to show that they're responding. At the same time, they want to avoid looking reckless. A cautious 25 basis point cut checks all the boxes. So what does this actually mean for you? If you've got a variable rate mortgage or a home equity line of credit, you'll feel the impact almost immediately. Your payments could drop slightly, but not a huge amount, but enough to give you some breathing room. For example, on a $500,000 variable rate mortgage, a quarter point cut would mean a savings of around $70 to $100 a month, depending on your lender. That's not life-changing, but in today's economy, every dollar matters. If you're in a fixed rate mortgage, nothing changes right away. But bond markets often respond to the Bank of Canada's moves, and fixed rates are priced off of bond yields. If the bank signals a longer path of cuts, that could push fixed rates lower over time. So if you're up for renewal later this year or next, this announcement could set the tone for better options for you. For savers, this is the tough part. Lower rates mean GICs and high interest savings account will eventually pay a little bit less. If you're parking your money in those products, your returns could shrink. That's one of the trade-offs of the monetary policy. Relief for borrowers comes at the expense for the savers. For business owners, cheaper borrowing costs means easier access to capital. Whether it's financing equipment, managing cash flow, or taking on new projects, a small cut in rates can help ease the pressure. And for investors, this decision will ripple through the market. Stocks often get a boost from lower rates because it means that the cheaper money is potentially more growth. But the bank's tone will matter even more. If they sound cautious and highlight risks, markets could react with more volatility. So here's what I'd suggest watching closely after the announcement. The statement, not just the numbers, but the words. Does the bank highlight growth risk, inflation risk, or both? The emphasis matters. Forward guidance. Do they hint at more rate cuts to come, or do they say that this is a one and done move? That will set expectations for the rest of the year. Market reactions, bond yields, the Canadian dollar, and the START market will all move. Those reactions gives us clues about how investors are interpreting the bank's stance. Now, big picture. Don't overreact to a single announcement. The Bank of Canada meets every 6 weeks, and this is just one step of a long journey. But these announcements are like mile markers on the road. They tell us where we are and where we might be headed. For households, the best approach is to stay prepared, not panicked. If you're coming up for renewal, explore your options early. If you're carrying high interest debt, look at ways to consolidate while rates are easing. And if you're thinking of buying a home, this kind of move could shift affordability slightly. But remember, it's not just about the rates today, it's about where rates are going to be over the next few years. So the resolution is this: expect a cautious cut. Prepare for ripple effects across mortgages, savings, and investments, and pay close attention to the tone of the bank's message. Because in times like this, the words can be just as powerful as the numbers. And as always, my job is to help you navigate these changes. Cut through all the noise and make sure you're in the best possible position no matter what the Bank of Canada decides next week.